Welcome back to All Things Money. My name is David Blain, and today we're discussing a little bit more about exchange-traded funds, or ETFs. If you haven't heard about them, they are the latest. I shouldn't say the latest. They've been around for a number of years, but they're becoming the vehicle of choice for implementing investment strategies. I sit on the finance committee of the college that I went to. And at the institutional level, we see more and more institutions using exchange-traded funds as opposed to mutual funds. And it's certainly something, if you're not in tune with, we're going to try to teach you on this show, but I encourage you to go out and do a little bit of research on your own as well. If there's another topic that you'd like discussed on the show, or you have a question about what we talk about today, feel free to give us a call. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And you can visit us on the web at www.dlblain.com. That's DLBLAIN.com. And there you'll find archived copies of the show as well as some information about myself and my firm. Well, without further ado, let's get back to what we were discussing before the break about exchange-traded funds. I was talking about how with the increased correlation in the stocks, in the markets, as well as some of the bond markets, it's very difficult for an active mutual fund manager to exceed the performance of the market as a whole. And I just thought I would give you a little examples. Let's say you're an active manager and you're looking around, you're trying to buy a big pharmaceutical company, and you're looking at, companies like Pfizer and, companies like that, and you're trying to select which one you think is going to grow more than another. Well, in an environment like today where the markets are being moved by these global macro forces, and you have traders buying and selling the stocks at very high frequency, especially if he buys, say, a pharmaceutical ETF, it's going to raise and lower the prices of all the pharmaceutical companies in that ETF, no matter what the fundamentals are. And so it's very difficult to select an individual company today when the markets are being moved by these large trades that are buying baskets of stocks at a time. One of the things that high-frequency trading also does is it makes it much more difficult for stocks to become mispriced. That it's generally felt that the process of buying and selling securities is where you reach the price, the fair market price. And so the more stocks are bought and sold, it's generally felt like you reach a better consensus of the value. For example, if only one share of Coke stock was offered for sale on any given day, it may not reflect the true value of that stock. But when you have millions of market participants buying and selling that same stock during the day, it's generally accepted that value comes close to what the current value is. Now, someone may say that over a long time that company is over or underpriced, and I would grant that, but certainly on a shorter term basis, the markets are very efficient, and the larger trading volume in a given day in a given security brings that price closer to the value that it is at that current moment. Transparency is another benefit for the ETF world. Is when you purchase, let's go back to that pharmaceutical ETF, you purchase that ETF, you know exactly which stocks it's going to hold. You know that it owns 10% of Pfizer, 5% of Abbott, or whatever. You know exactly what it owns. With a actively managed mutual fund, you do not know. They're only required to release their holdings on a periodic basis. So we like the transparency of exchange-traded funds. The stock and bond or commodity exposure is largely becoming a commodity itself, that with exchange-traded funds you're able to target various sectors of the economy, various industries, specific countries, and so the individual companies themselves have become less significant as people, for example, people buying the whole Brazilian stock market, the Brazilian exchange traded fund. Well, the individual companies on that market become less and less important as people just purchase the whole exchange traded fund. Now, the other advantage of ETFs is the cost. And at our firm, we're big on making sure that we keep the cost very low for the investor. We think there's a lot of value to be added by having a wealth manager or someone that's managing your money for you, but we don't think that you need to pay too much just for the investment portion. And so by using exchange-traded funds, you're able to keep the costs low. And we're not alone around the country. The cost advantages of ETFs are well known over the active funds. Now, this is not to say it's always going to be this way. We weren't on the air 5 years ago, but if we were, we would have been talking mostly about individual stocks and bonds. The correlations were not as high as they are today, and we used individual stocks and bonds. We felt like there was still the ability to outperform picking individual stocks and bonds. The current market is extremely difficult, and so now we use mostly exchange-traded funds. This is not to say in the future, if markets change, and they do all the time, as an investor, you have to keep up with the changes not only in the economy, but the financial markets themselves. And it may very well be in the future that individual stocks are preferable over any type of pooled vehicle like exchange-traded funds. And we will certainly change if that becomes the case again in the future. But for now, we think you should take a hard look at exchange-traded funds. When we come back from the break, we're going to talk about a specific category of exchange-traded funds that we think you need to take a look at. So for All Things Money, this is David Blain, and we'll be right back.